presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak YouTube update for October the 3rd, 2023. I'm Mo Ansari, President of Compak Asset Management, and all of you that listen to the daily broadcast on the radio stations, well, it's coming to an end. All good things are coming to an end, but we're not, the show must go on, so we're going to move to a digital format. You can get the 1 hour broadcast just simply by going to compak.com/media and downloading the app on your iPhone from the iPhone store and from the Apple store, and you'll get the broadcast, the 1 hour broadcast all the time. You can also subscribe to this YouTube channel and get the weekly YouTube updates. So don't forget to do that. I'm going to talk a little bit about the Fed. The big news this week, interest rates are exploding to the upside, and that had the market on the back foot. I talked about this a couple of months ago in July. I said, interest rates might go up and everybody will be running around, hair on fire, the world is ending, the Fed is going to kill it. That's where we are now. But we're also at the end of the seasonal time frame where we mark a bottom, usually by the middle of October. Well, today's October 3rd. We might get a little bit more movement to the downside, and then we start putting in a bottom and go from there. And I'll talk about that in a second. Talk a little bit about the market. We'll take a look at the weekly technicals and then the week ahead. I think the Fed, again, interest rates weigh on the stock market. Again, rates go up, stock market comes down. That's really what we have seen. Whenever rates spike up, stock market comes down. Rates spike up, markets come down. That's usually the scenario that we see in the stock market. The Fed, again, has said that they're going to raise interest rates until inflation is dead. But as I said, if they get after July, I said that will be the last interest rate increase. That was my guess. Now there's about a 30%, 38% chance they're going to raise and not do anything in November, but do it in December, 38% chance. I think the Fed, if this market, especially if it starts to break, we are going to see the Fed come in very quickly and say, I think we've reached enough, the terminal rate, where we don't need to do anything else, and see how things settle out. As soon as they say that, that means that they've reached the peak of the interest rate cycle and the market stabilizes, starts going back up. But we might still be a couple of weeks away from that, and we could see a lot more volatility in the meantime. When the VIX index remains lower than previous sell-offs, and that's where it is right now. I mean, this was the banking crisis. We got to 25. This is the inflation. We got up as high as 33. We are close to 20 now as of today for the VIX, and that is showing a little bit of stress in the market, but not a lot. We've come right back up again right here, and we're up to about 20 in the VIX right now. As far as the economy is concerned, PCE, the inflation numbers came out on Friday. They were lower than expected. So I think inflation continues to go down. And this is for the first time. This is the Personal Consumption Expenditures Index, PCE. That's what the Fed looks at. And now it is in the first time below the 4% level in more than 2 years. I'm going to do a seminar in Scottsdale. I will be there, probably the last one I'm going to do this year in Scottsdale. So if you want to come and attend, call us. Make a reservation, go to compak.com/seminars right here at the bottom, and you can click on that, make your reservation. It is free. I'm going to a live webinar on the 14th of November. If you want to attend that, you can register there. Here we've seen the wave 1. These are the technicals. Wave 1 to the downside, 2, and we're in wave 3. 200-day moving average, this is it right here. It is at 42.02. That is critical support, right around 42 to 41.90. Why do I say 41.90? I think we have reached the bottom here, get a bounce up here for the fourth wave. That'll be wave 4, and then we come back down one more time for wave 5. That could take another week or so for us on the downside. If we break 42, the next number that I'm looking at is 41.92. If we break that, then I think we get to a little bit of a worrying about the market a little bit over the long term. Right now we're in wave 1, 2, 3, we're in wave 4, and then we should start wave 5 to the upside. and that should take us, this is a weekly chart where each line is 1 week, so this could take us into next year or middle of next year before we get up here. But we are at this critical level right here. We're at 42 and change today, 42.30, 41.92 is what I would watch. If you get below that, then all bets are off. NASDAQ 12,900 is the we didn't make a new low today below last week's low. I still think 12.9. We closed at 13.59 today. I think 12.9, and then we've got 12,500, which is the 200-day moving average. I think we should bottom out somewhere around here between 12.9 and 12,900 to 12,800 is where this comes in. On the weekly charts, we've got 12,300, which is the 200-week moving average. We've broken below the dot plot. We've been below that for a few weeks. We need to get above 13.6 to really get excited about the upside. 13,600. We're at about 13,000 as of today's close. This is the big story. Interest rates took off to the upside. Once we broke above the 4.33 right here, and this was last October's high in rates. We gapped above it right here. This was a gap we left on the charts. And now we've gone all the way up. The Fibonacci projections from here to here is 4.93 to 5.03. Today we closed at 4.80 on the interest rate. So a little bit higher in rates over the next couple of days. And then I think the Fed will cry uncle and say, oh, we've done enough. We don't mean to do any more. And if they say something like that, which I think they will, and plus we get earnings over the next couple of weeks, if we get those earnings and they come in better than expected, then I think rates start to subside a little bit, economy is slowing a little bit, inflation is coming down, we go back to our Goldilocks scenario. Gold broke below the 200-day, this is the 200-day moving average, we broke below it, looks like we headed lower. This is the next support right here, which is about 1811. That's what it looks like right now. We're in a long-term triangle sort of thing that we set up right here. We broke to the downside, and looks like gold is in trouble. Probably 1800, 1820 is the number that I'm looking at. Crude oil topped out at about $95 a barrel. Same about highs that we made right here. This was last January and February, March that we saw these highs. And from there, or October and December of last year. Now we've come back down, broke below the 20-day. Next support is about $85, closed at $89.42. Market is, I think, depending on how the economy does. If the economy slows, oil prices will come back down. And I think the Saudis, which were concerned about the Chinese economy, might increase production next year. And if they do, that'll take some of the shortages out of the market, and we can come back to the $70 to $80 mark. The week ahead, I'm looking at the big number. The employment number comes out on Friday. 165,000 jobs created is the number that everybody is looking for. Again, that is still creating jobs, but not at the rate that we were over the last few years, 250 to 300,000 jobs. So I think the economy will continue to slow. I think we are seeing mortgages push 8% now. It is going to have an impact sooner or later on the housing market and also on the rest of the economy. So I think we're getting closer to the point where the Fed has to come in and say, okay, we're good. This is all we wanted. And that's it. If they don't come out and talk in some dovish tones, then we could see this market really start a new bear market, and we start heading into a recession. But nobody wants a recession going into an election year. Politicians don't like that, so there'll be a tremendous amount of pressure on the Fed to back off, let rates stay where they are. They're not going to bring rates down, but even if they say they're done raising interest rates, could be the positive. Again, if you need help with our portfolios, go to compak.com. We'll be more than happy to help develop a plan for you. It is free, compak.com, compak.com. I'm Mo Ansari. I will be back with you at the same time next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.